Retirement accounts are where the long game of investing takes shape. They're built for patience, for compounding, and for the quiet discipline that comes from thinking decades ahead. Every tax advantaged account, whether it's an IRA, a 401k, or a 403b, is a structure designed to encourage saving by deferring, or in some cases eliminating, taxes on growth. The exam will test you on the differences between these accounts, who they serve, and how money moves in and out of them. But at its heart, this section is about understanding the incentives, how Congress uses the tax code to reward saving, and how those choices affect the path of an investor's life. The most familiar is the traditional IRA. Anyone with earned income can contribute, up to annual limits set by the IRS. Those contributions may be tax deductible depending on income and participation in an employer plan. Earnings grow tax deferred, which means no tax is paid on dividends, interest, or capital gains until the money is withdrawn. When distributions begin, every dollar withdrawn is taxed as ordinary income. Withdrawals before age 59 and a half generally face a 10% penalty, though exceptions exist for things like first-time home purchases, qualified education expenses, or certain medical costs. At age 72, required minimum distributions, RMDs, must begin. The account can no longer compound untouched. Then there's the Roth IRA. Here, the pattern reverses. Contributions are made with after-tax dollars. No deduction up front, but the earnings and withdrawals, if qualified, are completely tax-free. To qualify, the account must have been open for at least 5 years, and the owner must be at least 59 and a half, or meet an exception like disability or a first-time home purchase. Roth IRAs have no required minimum distributions. The money can remain invested as long as the owner lives and even be passed to heirs. For many investors, that freedom to let compounding continue without forced withdrawals makes the Roth IRA one of the most powerful tools in personal finance. Employer-sponsored plans come next. A 401k is the private sector standard. Employees contribute pre-tax dollars through payroll deductions. Employers often match a portion of those contributions, effectively a guaranteed return on the employee's savings. The money grows tax-deferred until withdrawal. At that point, it's taxed as ordinary income. For teachers, nonprofits, and certain hospital systems, there's the 403b plan, sometimes called a tax-sheltered annuity plan. It works much like a 401k, but is limited to employees of public schools and charitable organizations. Government workers and certain municipal employees may use 457b plans, which also allow tax-deferred savings, but with more flexibility on early withdrawals for those separating from service. All three share the same underlying concept. Money goes in pre-tax. Growth is untaxed while it compounds. Withdrawals later in life are taxed at ordinary income rates. Some plans allow for a Roth 401k or Roth 403b option. These blend the structure of employer plans with the after-tax nature of a Roth IRA. Contributions are taxed up front, but qualified withdrawals are tax-free. Unlike a Roth IRA, Roth employer plans still require minimum distributions unless rolled into a Roth IRA. For self-employed individuals, there are special structures. The CPIRA, or Simplified Employee Pension, allows business owners to contribute on behalf of themselves and their employees. Contributions are tax-deductible and limited to a percentage of compensation. The employer makes the contributions, and all employees receive the same percentage of pay. The Simple IRA for smaller employers combines employer and employee contributions in a lighter administrative format. And for those with no employees, sole proprietors, and independent contractors, the Solo 401k provides higher contribution limits by allowing both employee deferrals and employer profit sharing. Understanding contributions and distributions is only half the story. The other half is the tax relationship. When money goes into a qualified plan pre-tax, the deduction lowers taxable income today. But every dollar withdrawn later is taxed at full ordinary income rates. When money goes into a Roth account, it doesn't reduce today's taxes, but the future withdrawals, including all growth, are free. The difference is timing, pay now or pay later, and suitability depends on each investor's expectations about future income and tax rates. Qualified plans are governed by ERISA, the Employee Retirement Income Security Act, which sets standards for participation, vesting, funding, and fiduciary responsibility. ERISA protects employees by ensuring that plan sponsors act in the participants' best interests. It also defines who can participate, how long an employee must work before becoming vested, and what disclosure documents must be provided. Fiduciaries, those with control over plan assets, must follow the prudent person rule to act with care, skill, prudence, and diligence as someone familiar with such matters would. Now, for the Series 7, expect questions about rollovers and transfers. When an investor leaves a job or retires, they can move money from a 401k to an IRA. A direct rollover, where the funds move institution to institution, avoids tax withholding. An indirect rollover, where the investor receives the check, requires that the money be redeposited into another qualified account within 60 days. Otherwise, it's taxed and may be penalized. Only one rollover between IRAs is permitted per 12-month period. Direct transfers, trustee to trustee, don't count toward that limit. The purpose of all these accounts, the IRAs, the 401ks, the CPs, the Roths, is to give structure to the one thing investors can't buy elsewhere: time. Time for earnings to compound without interruption. Time for taxes to wait. Time for people to build enough that they can stop working and let their money do the labor instead. That's what these plans protect. Not just capital, but the rhythm of a lifetime of saving. In the exam room, these questions might look like tax tables and contribution limits, but what they're really testing is understanding. Who benefits, when the taxes apply, and why the rules exist. And in the real world, they test something deeper: the ability to think beyond this year's market, beyond next quarter's statement, to think like someone planning for the next 20 years. Because that's what retirement saving really is: a way of saying, I trust the time ahead.